All right, let's get right into it. Welcome to The Explainer. Today we're tearing into the first half 2026 financials for Fortum. This company is a literal juggernaut in the highly volatile Nordic energy market, and what we're looking at today is an absolute masterclass in how you monetize grid constraints and macro volatility. Seriously, if you're tracking European energy equities right now, you absolutely cannot ignore this report. Let's hit the numbers driving this earnings blitz.
53.1 euros per megawatt hour. That is Fortum's realized blended market price for the first half of the year. Now, the context here is what's really wild. They pulled off this massive realized price despite actually having lower overall physical generation volumes. How? Well, they locked in high prices early with a massive hedge ratio. That basically allowed them to extract way more capital per unit of energy. They're taking these incredibly tight market conditions and just using them to absolutely supercharge their top line.
But, just capitalizing on today's prices, not quite enough. Section 1. Growth and Catalysts. Generating Shareholder Value. So Fortum is going entirely on the offensive here. They recently announced a public tender offer for Norwegian Elmera AS. The strategic rationale for this: it is aggressive and it is crystal clear. They're stepping in to consolidate a highly fragmented Nordic retail market. By swallowing up Elmera, Fortum is hunting for some truly massive cost and operational synergies, basically using their sheer scale to drive competitive pricing and efficiency. This is your classic high-conviction M&A play, custom-built to just dominate the regional retail space. And while they're doing that, they're actively rotating their asset base. They're hitting the gas on the energy transition by locking in the closure of the Maripori coal plant in Finland by 2027. At the exact same time, we're already seeing these immediate, highly positive profit contributions from their brand new Pjolex wind farm. This is driven by exceptional capture rates, meaning they're perfectly timing their power sales for when grid prices actually peak. So they're shedding legacy carbon liabilities and instantly monetizing green assets. It's a really sharp pivot. All right, let's strip away the narrative for a second and look at the raw data. Section 2. Financial Health Breakdown for Q2 and H1 2026.
So the absolute crucial point is the top-line breakdown. First half 2026 sales surged to a staggering 3.1 billion euros. That's up from 2.6 billion just the previous year. And that explosive revenue growth, it completely cascaded down to the bottom line, pushing comparable net profit up to 478 million euros. I mean, they are quite literally printing cash in a highly complex macro environment.
And breaking that down really shows us exactly where that profit is coming from. If we look at the operating profit trajectory, there is a massive 57 million euro boost coming strictly from their generation segment. That completely offsets some minor headwinds they faced in consumer solutions, and it pushed their total comparable operating profit to a very healthy 627 million euros. Spot prices and hydro volumes. Yeah, they're definitely doing the heavy lifting for them right now.
Now, rapid growth can sometimes hide a really stretched balance sheet, right? But not here. 1.4x, that is Fortum's net debt to comparable EBITDA ratio. For a capital-intensive energy major, this is essentially a fortress balance sheet. It means they have immense liquidity, we're talking sitting on 6.5 billion euros in reserves, and plenty of dry powder to execute on their strategic pipeline without even coming close to straining their credit metrics. But to truly understand these margins, we have to zoom out a bit. Section 3, Sector and Competitor Landscape.
Back in May, there was a rapid, severe drop in Nordic hydro reservoirs because of historically low spring floods. Now, this isn't just a weather report, it is a full-blown supply shock. This physical constraint in hydro capacity directly correlates with the aggressive, jagged spikes in regional power prices we saw at the same time. Fortum was positioned perfectly to capitalize on this exact volatility.
It's really a perfect storm of macro volatility. Alongside those hydro constraints, we're seeing European ETS policy reforms actively pushing carbon emission prices higher. Throw in some extremely volatile mid-quarter rallies in gas and coal, and this dynamic effectively raises the absolute floor for baseline energy prices across the entire continent. And who does that play perfectly for? A low-carbon generator like Fortum, who can just sit back and sell at these elevated market rates.
Which leaves us with a really critical thought experiment. Armed with a fortress 1.4x leverage ratio, a massively cash-generating asset base, and a very clear, proven intent to consolidate a highly fragmented Nordic grid, what is Fortum's next massive M&A target? I mean, the Elmera deal proves they are hunting for scale. If you're watching this sector at all, that is the multi-billion euro question you need to be asking right now. Thanks for joining me on this explainer, and I'll catch you next time.